Good evening. This is Ken Long from Tortoise Capital. This is a sample trading strategy that we've built out of combining a number of techniques from different systems and frameworks. And this is typical of the kind of work we do in the advanced day trading course, the advanced swing trading course, where we put together a collection of beliefs and techniques and turn that into a strategy or a system. And so this is the case of a conceptual application of the frog box, reinforced with some other techniques about the statistics of the day and from the regression line crossover framework. And this is a technique that we use early in the morning, also at certain times of the day when we have reason to believe that we're at a major turning point, perhaps indicated by the OWL pattern, which is a particular implementation of our RLCO, the regression line crossover framework. But I want to really just show it as it's applied in the morning to get well started during the day. So it begins with an assessment of yesterday's close. That's this horizontal line. And this vertical line represents the opening bell. And we've got an open here. And so this the distance between yesterday's close and today's open is the gap. And we study the size of that gap by comparing today's gap against the last 30 days and the last 200 days of gap. And we compute a gap statistic, which gives us some insights about the potential size of the day ahead. So this is how we gain our first clue as to what kind of a day this is going to become, a large range or small range based on the initial assessment of the gap. And now let's suppose that we have price has moved directly north for some distance and then has given us what we call the 1, 2, 3 reversal pattern suggested by those three price bars right here. And we see that they are up here by the third Bollinger Band, or the Z3, which indicates an extreme move right from the opening. So that's not unusual to see that, particularly if you have a directional move after a gap and there's a follow through in the direction of the gap. Because Bollinger Bands are computed including the previous day's price action, so you get this very wide set of Bollinger Bands right from the open, and then price is moving along with them. At the same time, we have the volume weighted average price from yesterday was very near the close, and we compute the regression line 270, the moving regression line 270, and it's not unusual to see those starting off near yesterday's close and starting to move in the direction of the price, but slowly, because there's a lot of information involved in computing those, and it takes yesterday's data, and so the regression line 270 is slow to respond to a significant move like that, thus creating the investable opportunity, or what we call the area in play, or the playing field. We think of the regression line 270 as a reasonable target for long-term holders on any time frame. So if we have a significant move of price away from the 270 regression line, then we treat that as an opportunity for price movement to rejoin price with the RL270. Now, at some point, we will have our dragon indicator, which is the 10-period Bollinger Band, plus or minus a half a standard deviation. When price crosses that dragon and the 10-period regression line, which is usually very close to price, when they cross that dragon, we have the conditions for what we call a pocket trade, and our target in this case would be the closing of the gap. If this was a far enough move, we might say first target at the open, second price target to close the gap and to join the 270. So now what we have is an extreme move, the beginnings of a reversion back towards the mean, or reversion to previous price, and all other things being equal. By that I mean we've taken into account market context, sector context, and all of the computations that go into our daily preparation, and we're going to assume that all that has happened, and so we can place the context for this trade inside the broader market and sector and preparation context. And so for this particular symbol, we know what our minimum manageable risk box is. Now, that's the risk box that upon a movement of a certain distance from a swing high, in this case, that's the price at which we are prepared to enter, and we call it the minimum manageable risk box because that is a price amount that we should not take more than a 1 hour loss under normal circumstances, meaning when you account for slippage and liquidity, that we should not take more than a 1 hour loss. If we can do that, then we are reasonably confident saying that is a manageable risk. So now what I do is I take that manageable risk and I'm going to compare from where I get in. If it has moved a manageable risk box from that high, maybe reinforced by the price in the 10-period regression line crossing the dragon, this now becomes my tentative entry. I can take that box and measure the distance back to the reasonable target. And if I have at least 2 to 1, I'm showing 3 to 1 here, then I have a manageable trade or a frameable trade. Now, something that may reinforce our notion that this might be a local high is we study the distance from the open to the point of this working high of the day. We call that the gain stat. And so we measure the amount of price distance from the open to the high of each day for the last 30 days, compute some statistics on it as part of our daily preparation. So if we see a gap in a certain direction and price moves, if it moves a 1 full gain stat and then starts to roll over, we have reasons to believe that that may be the high of the day, and what we're going to get is a large move against that high of the day. So it's moved a gain stat up. We've got a 1, 2, 3 entry alert, cross the dragon confirmed. We have a minimum manageable risk box. Feel this is a low risk entry. If I have 1, 2, even 3 risk boxes or reward boxes down to the regression line 270. The longer it takes for this to do that, the more the RL 270 is moving to join price. So there is sort of a built-in time factor into the cake. And then from once we've got the entry, it becomes a normal management practice to figure out when to move our stop to no lose plus dinner for 2 and remove our initial capital risk from this trade, and then simply see how much of this residual move that we're going to get based on what the market might do. So I want to come back finally to this notion of the minimum manageable risk box. We think this is where we get paid to improve our practice. I start with a standard frog box computed in the usual way to determine the size of my original risk box. Then, as I gain proficiency with that target or with that particular system, I start shaving down that frog box, and I start using a fraction of a frog box, starting at 0.9, working at 0.8. And the smaller I can shave that risk box down and still not take more than a 1 hour loss, the larger my position size can be, or the less my losses can be, the sooner I can reach my profit targets. And so I get paid in order to make subtle refinements here in the minimum manageable risk box, which allows me to frame more trades. I may also use a refined risk box, not just a fraction of a frog box, but just through experiential learning and analysis, I may be able to find what size box allows me to never take more than a 1 hour trade. I may end up using an average true range fraction if you feel better with that form. I may use the size of the intraday standard deviation, the one that's computed by Bollinger Bands. I may use that as a dynamic adaptive Z box or a Z-score box, so that's a function of intraday volatility. So there's no particular one that's better than the other. It's the ones that you can manage in the usual way without excessive cognitive load. but picking a standard risk box for your trades and then framing the trades and then incorporating some of these other favored indicators allows us to get a systems view of this trade strategy and allows us to see opportunities to trade from known points that look like they might be resistance points or highs of the day or a gain stat or a range stat limit to a particular move. As long as we have some reason and some evidence to believe that this might be an intermediate turning point, we can now start framing the trade in the other direction using standard units of reward and risk, reasonable profit targets, price confirmation, and then immediate action drills. Again, this will always be tempered by our read of the market context, sector context, and daily preparation, but that's part of our of our overall daily trading strategy. So, this is an example of the kind of advanced techniques that we'll talk about in the advanced day trading and the advanced swing trading course, because the same thing that we can do intraday, we can do on swing trading patterns as well, because the indicators we use are fractal in nature and allow us to apply standard framing techniques to many different time frames. We'll also talk about this kind of construction process in our systems thinking workshop as we look at using components from different systems in order to stitch together a new working model. So it's Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.